Gold is now at $4,414 an ounce, and most people still think it's just a shiny rock. Here is a question that will genuinely change how you think about your money right now. If you had to split new money 3 ways today, 1/3 into gold, 1/3 into housing, 1/3 into Bitcoin, what is the honest breakdown? Not the cheerleader version, not the doom version, the actual data. Because here is the thing, every week, people ask me where gold goes by end of 2026, they ask whether we hit $5,000, they ask whether housing crashes, they ask whether Bitcoin eats gold's lunch. And the honest answer is that you cannot answer any of those questions properly until you compare these 3 assets on the same criteria, at the same moment in history, with the same cold eyes. So that is exactly what we are doing today. Gold versus housing versus Bitcoin. Volatility, returns, crisis behavior, correlation, liquidity. 5 criteria, 3 assets, 1 framework. Let's go. Let's start with volatility, because this is where the story gets interesting immediately. Bitcoin's annualized volatility over the past 5 years has averaged around 70 to 80%. That means in a normal year, Bitcoin can swing up or down by nearly 3/4 of its own value, and that is considered normal. In 2022 alone, Bitcoin dropped from roughly $68,000 down to under $16,000. That is a 76% drawdown. If you put $100,000 in at the top, you watched it become $24,000 in about 12 months. Housing looks calmer on the surface. The U.S. national median home price fell roughly 5 to 7% peak to trough in 2022 to 2023 as rates spiked. But that surface calm is deceptive. Liquidity in housing, which just means your ability to actually sell and get cash, collapses exactly when you need it most. Right now, with the Fed funds rate sitting at 3.63% and mortgage rates still well above 6%, transaction volumes have cratered. Gen Z is publicly, loudly rooting for a housing crash in 2026, and honestly, looking at affordability ratios, you can see why. The average home price to median income ratio in the US is now near historic extremes. That is not a small thing. Gold's annualized volatility typically runs around 15 to 18%, less than a quarter of Bitcoin's. And unlike housing, you can actually sell gold at $4,414 an ounce on a Tuesday afternoon without finding a buyer, staging a property, or waiting 90 days for a closing. Value drop number 1. Gold is not just less volatile than Bitcoin, it is less volatile than many individual S&P 500 stocks while sitting at an all-time high. That combination, low volatility and new all-time highs, is genuinely rare. Now let's talk historical returns, because this is where most people get the comparison completely wrong. Bitcoin's 10-year return is extraordinary. If you bought in 2015, you are up something like 15,000 to 20,000%. Nobody disputes that. But survivorship bias is brutal here. 90% of the people who rode Bitcoin to life-changing gains did not hold through multiple 70 to 80% drawdowns without panic selling. The return on paper and the return in your actual portfolio are very different numbers. Housing over the past decade has delivered strong nominal returns in most US metros. But once you subtract mortgage interest, property taxes, maintenance, insurance, and transaction costs, the real return compresses dramatically. Studies suggest the net real return on owner-occupied housing over long periods sits around 1 to 2% annually. Robert Shiller's famous data going back over a century puts inflation-adjusted housing returns at close to zero over the very long run. Sobering, when people treat their home as their primary wealth-building vehicle. Gold since 2000 is up roughly 700 to 750% in nominal terms, from around $270 an ounce at the turn of the millennium to $4,414 today. That is a compound annual growth rate of roughly 9 to 10% per year over 25 years. Not Bitcoin's moonshot returns, but steady, real, and it happened while gold was supposedly just sitting there doing nothing. Value drop number 2. Gold has outperformed the S&P 500 over the past 25 years including dividends. Most financial advisors have not updated their models to reflect that. Now we get to the most important criterion in my view, crisis behavior, because this is where the 3 assets reveal their true character. In March 2020, when COVID hit and markets panicked, gold dipped briefly, then surged to new all-time highs within months, eventually crossing $2,000 for the first time. Bitcoin crashed 50% in a single week in March 2020 before recovering. Housing didn't crash at all in 2020 because the Fed flooded the system with money and mortgage forbearance programs artificially suppressed distressed sales. That is not organic resilience. That is intervention. In 2022, when the Fed aggressively hiked rates to fight the worst inflation in 40 years, stocks fell around 20%, bonds had their worst year in modern history, Bitcoin cratered 76%, and gold? Gold basically held its ground and finished the year down only around 1 to 2%. During an environment designed to destroy it, rising rates and a stronger dollar, gold barely moved. That is what central banks understand that retail investors often don't. Central banks globally added over 1,000 tons of gold in 2022 and again in 2023. They are not buying Bitcoin. They are not buying US housing. They are buying physical gold at record pace. Value drop number 3, central bank gold demand in 2023 was the second highest ever recorded in history, beaten only by 2022, 2 consecutive record years. This is not a coincidence. This is a structural shift. Now let's talk correlation, which just means, when stocks fall, does this asset fall with them, or does it move independently? Bitcoin's correlation with the Nasdaq has been stubbornly high during sell-offs, often 0.6 to 0.7 during periods of risk-off. That means when tech sells off, Bitcoin tends to sell off too. It does not give you the diversification you think it does, exactly when you need it most. Housing is illiquid and slow-moving, so the correlation appears low on paper. But again, when credit tightens, both stocks and housing prices fall together. The 2008 financial crisis proved that definitively. They were deeply correlated through the one channel that mattered, credit availability. Gold's correlation to stocks over long periods hovers near zero and can go negative during acute crises. That is the technical definition of a portfolio diversifier. Not an asset that merely looks different on paper but one that actually moves differently when the pressure is on. Value drop number 4, a portfolio holding just 10% in gold has been shown in academic studies to reduce overall portfolio volatility by nearly 20% without meaningfully reducing returns. 10% allocation doing that much work is genuinely remarkable. And finally, liquidity. Gold is the most liquid asset in the world after major currencies and US Treasuries. The London gold market clears roughly $30 to $50 billion per day. You can sell physical gold globally, instantly, at a transparent price. Bitcoin is liquid but operates in markets that close for maintenance and can experience liquidity crunches during exchange failures as we saw in 2022 with FTX. Housing is simply not liquid. It never is. And it becomes the least liquid exactly when everyone else needs to sell too. So here is the framework. If you were thinking about splitting new money across these 3 assets right now, here is how I would think about it. Gold is your anchor. It is the thing that holds value when the system is under stress, that central banks trust, that has a 5,000-year track record, and that right now at $4,414 an ounce is telling you something serious about what sophisticated money thinks is coming. Gold belongs in every serious allocation. Bitcoin is your asymmetric bet. Smaller position, because the volatility is real and the drawdowns are brutal, but the upside case is also real if you believe in the monetization thesis. Size it to what you can watch drop 60% without making an emotional decision. Housing is the trickiest one right now, with Gen Z praying for a crash, affordability at historical extremes, and transaction volumes frozen. This is not the moment to rush into real estate as a financial asset. If you are buying a home to live in, that is a different conversation. But as an investment in this environment, the risk-adjusted case is the weakest of the 3. I get asked constantly whether gold hits $5,000 by end of 2026. I am not going to give you a price target, because nobody actually knows, and anyone who pretends otherwise is selling something. What I can tell you is that the structural forces pushing gold higher, central bank accumulation, de-dollarization, fiscal deficits, real negative rates on and off, are not going away. The question is not really gold's destination. The question is, which side of this shift do you want to be on? Most people find out about these macro shifts after the move has already happened. By then the easy money is gone. If you want to track central bank gold buying, de-dollarization, and fiscal pressure in real time, before the mainstream catches on, this channel breaks it down every single week. Subscribe now and you will not be the last to know. Hit subscribe and turn on notifications so you do not miss the next one. And look, I should be clear, I am not a financial advisor, just someone who is genuinely obsessed with this stuff and shares what I'm finding. None of this is personalized advice for your situation. Do your own digging, talk to someone who knows your full picture, and always form your own view. That is the only honest thing I can tell you. And if this breakdown changed how you think about even one of these three assets, drop a comment below and tell me which one. I read every single reply. See you in the next one.